There's a 23-year-old in Wisconsin right now who just set up automatic investing, $10 every Friday. He feels good about it, responsible, like he's finally figured out the adult thing everyone talks about. In 40 years, if the market does what it's historically done, he'll have around $60,000. Sounds great, until you remember that in 40 years, $60,000 might buy you what $15,000 buys today. He doesn't know this yet, but you're about to. Let me show you something that nobody mentions in those cheerful investing apps with confetti animations. In 1984, the median home price in America was $79,000. A comfortable retirement was estimated at around $300,000 in savings. Put away $100 a month back then, let it grow for 30 years, and you'd actually be in decent shape. Fast forward to now, that same median home is $400,000. A comfortable retirement is estimated at $1.8 million. And that $100 a month, it's been psychologically downsized to 10, 20, maybe 50 if you're feeling ambitious, because rent is higher. Groceries cost more. Subscriptions quietly drain another $100 monthly. The math that worked in 1984 has been completely inverted, but the advice stayed exactly the same. Start small, stay consistent. Compound interest is magic. Except magic requires the right conditions, and the conditions changed. Here's how the small investing narrative actually started. It wasn't always about $10 deposits. The concept of retail investing, regular people buying stocks, barely existed before the 1970s. Before that, the stock market was for the wealthy, for institutions, for people with enough capital that the friction costs didn't eat them alive. Then came the 401k in 1978, a tax code change that accidentally became the blueprint for retirement. Companies loved it because pensions were expensive and unpredictable. Employees were told they loved it because now they had control. The financial industry loved it most of all because suddenly millions of regular people needed investment accounts, needed funds, needed advice. And the pitch was brilliant. You don't need to be rich to invest, just consistent. The market averages 10% annual returns. Time in the market beats timing the market. All of it true, technically, but true in the way that saying just eat less and move more is technically weight loss advice. Accurate, but incomplete. Because what they didn't mention was that 10% average returns don't mean 10% every year. It means some years you're up 30, some years you're down 18, and the sequence of those returns matters more than the average when you're working with small amounts. Let's run the actual math, not the hypothetical chart that goes up and to the right, the real version. You invest $10 a week. That's $520 a year. Over 30 years, assuming a 7% average annual return after inflation, you'll contribute $15,600 of your own money. With compound growth, that becomes around $53,000. $53,000 sounds meaningful until you realize the average new car costs $48,000 right now. You've spent 3 decades building a fund that buys you one vehicle. Bump it to $50 a week, now you're at $2,600 annually. 30 years gives you around $265,000. Better, still not retirement, still not financial independence, still not never worry about money again territory. The brutal truth is that small dollar investing was designed for supplementation, not transformation. It's meant to sit alongside a pension or a paid-off house or some other major asset. But pensions are nearly extinct. Housing costs have exploded relative to wages. So now this supplemental strategy is being sold as the primary plan, and it's not built for that load. Here's where it gets uncomfortable. The investing industry makes more money when more people invest more often. That's not a conspiracy, it's a business model. Expense ratios, management fees, trading costs, most are tiny, fractions of a percent, but they're calculated on total assets under management. If 10 million people are each investing small amounts across decades, that's enormous stable revenue. The incentive isn't to tell you that $10 a week won't move the needle. The incentive is to get you into the system and keep you there. And the way you keep people in the system is by making them feel like they're doing the right thing. So the messaging is relentlessly positive. You're securing your future. You're being smart. You're beating the people who don't invest at all. All of which is technically true, but it's the financial equivalent of saying you're beating traffic because you're moving 5 miles per hour instead of 0. You're still not getting where you need to go at the speed you need to get there. And the apps know this. The gamification, the portfolio balance screens that round up to make your account look fuller, the celebration notifications when your portfolio hits a new milestone. It's all designed to make small numbers feel significant. Now let's contrast this with how wealth actually gets built, not in theory, in practice. The people who retire comfortably, who achieve financial independence, who stop worrying about money, they generally did one of a few things. They earned significantly above median income and saved aggressively. They owned assets that appreciated faster than inflation, usually real estate or equity in a business. They inherited wealth, or they took concentrated risks early that paid off. Notice what's missing from that list: consistent $10 deposits. Because here's the thing about compound interest. It's incredibly powerful when you have time and when you have a meaningful base to compound from. If you start with $10,000 and add $500 a month, you're in a completely different game than starting with 0 and adding $100. The math isn't linear. Doubling your contribution rate doesn't double your outcome. It can triple or quadruple it depending on timing. And starting with a lump sum, even a modest one, dramatically changes the trajectory. But most people don't have a lump sum. Most people are starting from 0 or close to it, so they're told to start small, which is better than not starting, but better than nothing is not the same as sufficient. The gap between those two things is where the discomfort lives. There's another layer here that doesn't get discussed much. Inflation isn't uniform. The average inflation rate might be 3%, but that's not how you experience it. Healthcare costs rise faster. Education rises faster. Housing in desirable areas rises much faster. The things you actually need to buy with your future dollars are inflating quicker than the average suggests. So when you're projecting 30 years forward, assuming 7% growth and 3% inflation gives you a 4% real return. Sounds reasonable, but if the things you need have been inflating at 5 or 6%, your real purchasing power is growing slower than the model suggests. This is why you hear stories about people who did everything right and still feel financially squeezed in retirement. They hit their number. The number just wasn't enough because the cost structure of life shifted under them. And here's the darker part. The longer you rely on small contributions, the more vulnerable you are to sequence risk. If the market crashes early in your investment timeline, it barely matters. You're buying shares cheap. But if it crashes right when you're trying to retire, when your account balance is finally meaningful, you can lose years of progress in months. Small account balances can recover from crashes because you're still adding money. Large account balances that aren't being added to anymore are fragile. And the $10 strategy keeps you in the fragile zone longer because it takes so long to build critical mass. So what's the alternative? That's the question, right? If small investing won't get you there, what will? The honest answer is uncomfortable. You need to either earn more, spend less, or take more risk, preferably all three. Increasing your savings rate from 5% to 20% of income does more than quadrupling your weekly deposit. It changes the entire equation. Or you focus on acquiring assets that have asymmetric upside, starting a side business, developing a high-income skill, buying real estate in an emerging area, all of which require more than just consistency. They require capital, time, knowledge, or risk tolerance that most people don't have or aren't willing to deploy. And that's the trap. The $10 strategy exists because it's accessible. It doesn't require expertise. It doesn't require a lot of upfront cash. It doesn't require you to make scary decisions. But accessible and effective are not the same thing. The financial industry has solved for accessibility. They've made it so easy to start investing that it feels almost irresponsible not to. But they haven't solved for effectiveness at the small scale. They can't. The math doesn't work. So instead, they sell you on the process. Trust the system. Stay disciplined. Don't try to time the market. All good advice for someone who's already on track. borderline gaslighting for someone who isn't. Here's the part that might sound nihilistic but isn't meant to be. For a lot of people, small investing serves a psychological purpose more than a financial one. It makes you feel like you're doing something. It creates a narrative of responsibility and future planning. And in a world where so much feels out of control, that narrative has value. But you need to know what you're actually buying with that $10 a week. You're buying peace of mind, a sense of progress, the ability to say you're invested in your future. Those are real benefits. They're just not the same as buying financial independence. If you go into it knowing that, fine. If you view it as one small part of a larger strategy, great. But if you think consistency alone is going to carry you to wealth, you're going to be disappointed. Not because you did anything wrong, but because the system wasn't designed to get you there.